On a scale of 1 to 10, and this is the only way I think I can maybe ask this one, but on a scale of 1 to 10, how concerned are you about inflation right now?
Oh, I don't know, like an eight to 10 or something like that.
Mhm.
We're beginning a paradigm shift. And when that shift starts to take place, you see behavioral shifts that reinforce that cycle in the paradigm. So, for example, when there is the selling of bonds, that it makes it more inflationary in and of itself because the amount of debt that has to be sold is not just the deficit, but also the amount of debt that's being sold is those bonds. So now interest rates have to rise a lot, or the Federal Reserve has got to come in there and buy more. And then you get wages. People make wage settlements and such things.
It's no secret that Americans have been struggling with stagnant wages for years. But what's often overlooked is the relentless rise of inflation. Today, we look deeply into this pressing issue with the help of Ray Dalio, a renowned investor and economist, who warns that American salaries might soon face even harsher pressures. We'll explore how wages and inflation are trending and what this means for your financial future. Plus, we'll look at how smart investing could be your best defense against these economic shifts. Well, most of us are painfully aware that our incomes haven't kept pace with inflation, a trend that's becoming increasingly obvious. But let's unpack this further with a closer look at some recent data. Data shows that U.S. wage growth for advertised roles reached a peak of 9.3% year over year in early 2022. Since then, it has dropped dramatically due to a decline in the need for workers. It fell so low that it reached 3.6% in January 2024, and the downward trend continues. Contrastingly, CPI inflation, which also peaked in June 2022 at 9.1%, has not seen a similar decline. Instead, it's remained stubbornly high and has even started to inch upward again in recent months. This persistent gap between wage increases and inflation is causing real financial strain for many Americans. Ray Dalio, a prominent economist, stresses the importance of recognizing these trends for what they are, a sign of deeper economic imbalances. Historical data shows that when inflation rates exceed wage growth, purchasing power is eroded. This erosion means less real income for families and individuals, impacting their ability to cover essential costs like housing, food, and healthcare. Currently, this situation looks particularly bleak. The wage growth that peaked is now seeing a reversal, while inflation stubbornly remains at elevated levels. This combination is effectively shrinking disposable incomes, putting additional financial pressures on many households. Analysts from job marketplaces like Indeed corroborate this troubling trend, pointing out a significant slowdown in wage increases across various sectors. This deceleration in wage growth, nearly 3 percentage points in just 1 year, could signal tougher economic conditions ahead. What's more, this isn't just a momentary blip. Economic forecasts suggest that these trends might persist, with inflation potentially outpacing wage growth into the near future. Such a scenario could lead to a worsening cost of living crisis, where even maintaining a basic standard of living could become challenging for a significant portion of the population. Understanding these economic dynamics is a must. It's not just about the numbers, it's about the real impact on people's lives. Families might need to tighten their budgets even more, and individuals might have to defer important life decisions, like buying a home or investing in education, due to these financial constraints. This sobering look at the economic landscape, as outlined by experts like Ray Dalio, provides valuable context for what many are experiencing. It's a call to action for policymakers and a wake-up call for individuals to reassess their financial strategies in light of broader economic forces. As we look into more of these issues, understanding the mechanics behind wage stagnation and inflation will be key to navigating the challenges that lie ahead.
Inflation levels are today, and given how much debt this country is in fact sitting on?
Well, there's two ways of dealing with debt. You pay it back in hard money or you pay it back in soft money. You pay it back in hard money and you have a problem. You have a depression. So throughout history, whenever that was done, paid back in hard money. Eventually, that was abandoned and you print money. That was what 71 was. That was what March 1933 was.
He argues that the disconnect between wages and inflation is not merely a temporary mismatch, but part of a larger structural economic shift that could have long-lasting effects. According to Dalio, the combination of high inflation rates and stagnating wages is indicative of deeper economic vulnerabilities. Dalio's perspective sheds light on a major economic shift: the transition from a post-World War II economic era, characterized by robust industrial growth and rising wages, to a new paradigm where technological advancements and globalization are reshaping economic landscapes. He suggests that these factors contribute to a stagnation in wage growth despite increasing productivity, as technology replaces traditional jobs and global competition suppresses wages. In his detailed analysis, Dalio points to the widening wealth gap as a significant consequence of these shifts.
The second is this conflict, this polarization, this wealth gap, and how we're at each other's throats. And I looked at the wealth gap, and I looked at a lot of measures of conflict going back in time, and I found that they were in the 1930 to 45 period.
The top echelons of society continue to see their incomes grow through capital investments and asset appreciation, while the average worker finds it increasingly difficult to maintain, let alone improve their standard of living. This divergence, he warns, not only stifles economic growth by limiting consumer spending, but also promotes social and political instability. Dalio also highlights the role of monetary policy in exacerbating these trends. Central banks around the world have responded to economic slowdowns with lower interest rates and quantitative easing, which have inadvertently driven asset prices higher. While these measures are meant to stimulate the economy, they disproportionately benefit those who own assets, further increasing inequality. This complex backdrop sets the stage for what Dalio describes as a beautiful deleveraging, where the economy could potentially balance out through a combination of debt reduction, austerity measures, and redistribution policies without leading to a major economic downturn. However, achieving this balance requires careful policy management and a deep understanding of the underlying economic dynamics. The implications of Dalio's insights are profound for investors and policymakers as well. For investors, understanding these macroeconomic trends is crucial for making informed decisions that align with the long-term economic cycles. For policymakers, Dalio's analysis serves as a call to action to address structural issues that, if left unaddressed, could lead to deeper economic crises. As we consider these economic insights, it becomes clear that the challenges we face are not just about fluctuating economic indicators, but about fundamental shifts in how our economies operate. Recognizing and adapting to these changes is essential, not just for individual financial health, but also for broader societal well-being. As we move forward, Dalio's call for a more equitable economic approach might just be the compass we need to navigate these turbulent waters. Acknowledging the economic challenges is only the first step. The next step is figuring out how to safeguard and potentially grow your finances in such a climate. Investing wisely has never been more critical, and as Ray Dalio suggests, understanding how to leverage the financial system is vital for success. Dalio advocates for using investments as a tool to combat the effects of stagnant wages and rising inflation. He points out that while average wage increases have struggled to keep up with inflation, the investment markets, particularly equities, have been substantially grown. For example, over the past 5 years, major indices like the S&P 500 have surged nearly 75%. This significant growth in the stock market presents an opportunity for individuals to grow their wealth through strategic investments, even in times of economic uncertainty. The key, Dalio emphasizes, is financial education. By understanding the economic environment and the mechanisms of investing, individuals can make informed decisions that protect and enhance their financial well-being. For example, knowing when to enter or exit the market, understanding the importance of diversification, and recognizing the signs of economic shifts can all drastically improve investment outcomes. Moreover, Dalio suggests that individuals look into more resilient investment options such as bonds, gold, and real estate, which tend to hold their value or even appreciate during times of high inflation. These assets can serve as a hedge against inflation, helping to maintain the purchasing power of your savings. He explains that while these assets might not offer the explosive returns of high-growth stocks, they provide stability and security, which are invaluable during periods of wage stagnation and rising living costs. Furthermore, Dalio highlights the importance of passive income streams. Investments that yield regular dividends or rental income can supplement wages, providing a steady cash flow that can help cover expenses when wages are not rising fast enough. For example, dividend-paying stocks or income-generating real estate properties can be particularly effective in providing outgoing income without requiring the sale of assets. Dalio also stresses the long-term view of investing. Short-term market fluctuations can be scary, but a well-thought-out investment strategy focused on long-term goals is more likely to yield positive returns. He advises against reactionary investment behaviors driven by market panic or hype, advocating instead for a disciplined approach that aligns with one's financial goals and risk tolerance. So where do you start? First, assess your current financial situation and define your long-term financial goals. Whether it's building an emergency fund, saving for retirement, or generating passive income, your goals will dictate your investment strategy. Starting with the basics, Ray Dalio suggests that the first step in investing is to gain a solid understanding of your financial standing. This means knowing your income, expenses, debt levels, and investment capabilities. The clearer you are about your financial health, the more effectively you can plan your investment strategy. For example, if you're carrying high-interest debt, your initial focus should be on reducing that burden before committing substantial funds to the stock market. Once you have a handle on your finances, the next step is to educate yourself about the different types of investment vehicles available. Dalio emphasizes the importance of understanding the characteristics of stocks, bonds, mutual funds, ETFs, and real estate investments. Each type of investment carries its own set of risks and benefits, and it's important to choose those that best align with your financial objectives and risk tolerance. Dalio also advocates for the creation of a diversified investment portfolio. Diversification isn't just about spreading your money across different investments. It's about strategically balancing the portfolio to mitigate risks and maximize returns. For beginners, this might mean starting with a simple mix of stocks and bonds and gradually incorporating other assets like real estate or commodities as you gain more confidence and experience. Furthermore, Dalio highlights the importance of setting up an automated investment plan. This can be done through regular contributions to a retirement account like an IRA or a 401k, or through a taxable brokerage account where you can invest in a broader range of assets. Automation helps in building wealth consistently without having to actively manage every transaction. For example, setting up automatic transfers to purchase index funds or ETFs monthly can help you take advantage of dollar cost averaging, reducing the impact of volatility on your overall investment. Another critical aspect Dalio discusses is the mindset of a successful investor. Investing is not just a mechanical process of allocating money, but also involves managing emotions and expectations. He advises against the temptation to follow market trends or react impulsively to short-term market movements. Instead, focus on your long-term financial goals and maintain discipline in your investment strategy, regardless of market conditions. In short, taking the initial steps into investing can seem daunting, but by following Dalio's advice, you can simplify the process. Start by understanding your financial situation. Educate yourself about investments. Diversify your holdings, automating your contributions, and then maintaining a disciplined approach. These steps form the foundation of a successful investment strategy that can help you navigate the complexities of the financial world and achieve your long-term financial objectives effectively. While the outlook for wage growth relative to inflation may seem bleak, not all is lost. With the right knowledge and strategies, you can protect or maybe even enhance your financial well-being. And remember, the key to succeeding in this complex economic environment is preparation and action. Start by understanding the economic landscape, then take proactive steps to invest wisely. As Ray Dalio advises, becoming financially educated isn't just an option. It's a necessity for weathering the storms ahead and thriving in the future. Given Ray Dalio's insights on the economic shifts and the importance of financial education, what steps are you planning to take to enhance your financial literacy and prepare for future economic challenges?